Industrial demand plus safe haven, the real drivers behind silver's spike. 12 minutes. 100 words. Something unusual happened in the world of metals over the past year, and if you blinked, you might have missed just how significant it was. Silver, the metal that tends to get overshadowed by gold in almost every conversation about precious metals, quietly put together one of the most impressive price runs of any asset class in recent memory. A metal that started 2025 trading around $29 an ounce, ended the year somewhere between $70 and $83 an ounce, depending on which part of the chart you're looking at. That's a gain of somewhere between 144% and 147% in a single year. Not a speculative meme stock, not a cryptocurrency. Silver, the stuff used in solar panels and circuit boards. So what actually drove that? There were very clear structural forces behind it, and understanding those forces tells you a lot about where silver sits in the global economy right now. Let's break it down. The first thing to understand about silver is that it is fundamentally different from gold. Gold is almost entirely a monetary and investment metal. About 90% of its demand comes from jewelry, central bank reserves, and investor buying. Industrial use, roughly 7%. Silver is essentially the opposite. Over the past 5 years, according to the Silver Institute, industrial demand has accounted for approximately 54% of total silver consumption annually, more than half. That means silver isn't just reacting to what investors think about inflation or Federal Reserve policy. It's responding to what factories and engineers actually need every single day. And what they need it for is growing rapidly. Solar panels are perhaps the single biggest story here. Silver is used as a conductive paste in photovoltaic cells, and as global solar installations have scaled up aggressively, particularly out of China and increasingly across the United States and Europe, silver demand has followed. The Silver Institute's December 2025 report titled Silver, the Next Generation Metal, laid out that clean tech alone is expected to sustain heavy silver demand well through 2030. EV-related silver demand jumped an estimated 20% in 2025, driven by high-voltage wiring, advanced connectors, and power management systems. As vehicles become more electronic and software-intensive, the amount of silver packed into each unit continues to rise. Then add AI infrastructure. Data centers are now emerging as a meaningful demand category for silver, using it in high-efficiency electrical components, precision contacts, and thermal management systems. This is not a trend that existed 5 years ago at any meaningful scale. It's new, it's growing, and it stacks directly on top of the solar and EV demand already pulling at this market. Now, here's where the supply side gets uncomfortable. Silver mine production is largely what's called a byproduct. Roughly 75% of it comes out of the ground as a secondary metal when miners are primarily digging for copper, zinc, or lead. That means decisions about how much silver the world produces aren't driven by silver prices. They're driven by the economics of entirely different metals. Even as silver surged through 2025, there was no meaningful rush to spin up new primary silver mines. Mexico, the world's largest silver producer, saw output roughly flat at around 186 million ounces for the year. Total global mined supply remained essentially flat year over year, around 813 million ounces. Set that against demand that keeps climbing, and you get a structural deficit, a situation where the world is consuming more silver than it's producing. 2025 marked the 5th consecutive year in which that deficit persisted, according to data from Metals Focus. The cumulative shortfall from 2021 through 2025 is estimated at close to 820 million ounces. That is not a small number, and it helps explain why silver markets have been getting progressively tighter, why exchange inventories have been drawing down, and why lease rates on physical silver hit record highs during the year. When you have a market that's been eating into its own above-ground stockpiles year after year, the cushion gets thinner. But here's what makes silver's 2025 story particularly interesting. It wasn't only the industrial story doing the work. The second engine was the return of safe haven demand. And this part of the equation is worth understanding separately, because it layers on top of the industrial story in a way that creates compounding pressure. Throughout 2025, global investors were navigating a cocktail of uncertainty. Tariff disputes created unpredictability for manufacturing and trade. Geopolitical tensions elevated risk aversion globally. Questions about the Federal Reserve's independence and the long-term trajectory of U.S. government debt put pressure on confidence in the dollar. Inflation, while declining from its peak, remained stubbornly above the Fed's 2% target. In that environment, the traditional reflex is to move capital toward assets perceived as stores of value, and gold leads the charge. But when gold runs, silver tends to follow with amplified moves. That dynamic played out clearly. Gold rose roughly 65% in 2025. Silver more than doubled that gain. The gold to silver ratio, which had briefly stretched above 107, meaning it took more than 107 ounces of silver to buy 1 ounce of gold, compressed back towards 78 by October, suggesting institutional money was actively rotating into silver. Silver-backed exchange-traded products rose roughly 18% in holdings through November, generating an inflow of 187 million ounces year to date. That's investor capital, treating silver not just as a commodity, but as a monetary asset. When the Federal Reserve followed through on rate cuts in late 2025, that gave another tailwind to non-yielding assets. Lower real interest rates reduced the opportunity cost of holding silver compared to bonds. Markets began pricing in additional cuts through 2026, keeping a floor under silver even during periods of consolidation. So, as of early 2026, silver sits at an interesting crossroads. The industrial story hasn't gone away. Solar, EVs, AI infrastructure, and power grid upgrades are all ongoing multi-decade structural trends. The supply deficit is projected to continue into its 6th consecutive year. And the macro environment, geopolitical uncertainty, evolving Fed policy, dollar dynamics, continues to make the safe haven argument for silver relevant. What analysts are watching most closely is whether those two engines, industrial demand and safe haven capital, stay aligned. When they pull in the same direction, as they did through much of 2025, the math on a structurally undersupplied market becomes very clear. When they diverge, volatility follows. Silver has always been more volatile than gold precisely because of this dual nature. What's observable, based on the data heading into 2026, is that the fundamental reasons behind silver's run were not speculative in origin. They were grounded in manufacturing realities, supply chain math, and a macroeconomic backdrop that continues to keep a wide range of market participants attentive to this metal. Understanding those drivers is the starting point for understanding silver, and for making sense of what this market is telling us about the broader global economy right now.